Hey guys, what is up? It's Arthur here and welcome to this video in which we'll be talking about Johnson & Johnson, ticker symbol JNJ. But first, before we do that, two things that I would like to put out as sort of public service announcement, PSAs. First is I would like to try and post more frequently, and that is because of number two is because I'm trying to warm up to the idea of creating a course to help you get a better understanding on all these things related to stock investing. But don't worry, I plan to start selling it from just $1 single. So if you don't want to miss out on that, make sure that you're subscribed and that you visit my website arturnagyi, arturnagyi.com, and you can find a email subscription box on the bottom of the page. Put your email in there. I get your contact information that way, and I can make sure that you get an email when the course launches without any kind of algorithm intervention, and we can make sure that you can get it at a very fair price, making it one of the best investments that you can make. And I know the kind of content and quality that you will be getting. I went to business university for 5 years for this. You're getting the condensed version, so you don't have to fork out all the money and spend all the time. You can do it, watch it at the comfort of your own home. I get to make some money. Everyone's a winner, hopefully. So with that being said, let's get into this. We're talking about Johnson & Johnson. And if you don't know, it's a holding company. A large company bought a lot of other things. And they engage in this research, development, manufacturing, and sale of products in the healthcare field. So you're researching and retailing, basically. They have two separate segments, and they have various segments that they focus on. Now this, as we can see here, first just a quick look at the graph, because we don't really care about the graph and past prices, but for the past 1 year it's been relatively stable. And if we even zoom out 5 years, you will see that it is sort of also very stable. There are not like huge ups and downs. And that's what you would call a defensive stock, most probably. I know Johnson & Johnson for their mouthwash, and I think they have like sort of like an eye drops, and also I think baby powder Johnson's, whatever they are called. So I know them for that, and these are things that people are gonna buy anyway, regardless of the economic situation. Shampoo and body wash and all that kind of things are the things that people are going to buy, even if it's a good time in the economy or a bad time, because you sort of need those to run your household and manage yourself. I always thought of JNJ as a pair to Procter & Gamble, ticker symbol PG. So for me, they just come in pairs. Both of them own a lot of brands, but this is, even though this is more leaning into the healthcare sector, they have a lot of products that people will just keep buying. And because it is so recurring, there isn't much deviation from your standard line. Let's see how they've been doing for 10 years. Now you can expect this to going a little bit up. As you can see, we are in sort of an uptrend, as only the recent time period is what's been negative and going down, but that's what we call a discount if you see value in the stock. Yes, on 10 years we're going up, but again, we don't really care about past prices. I'm just showing this to you to talk about defensive stocks. Market cap of 360 billion. This is a large company, a very large company. When we talked about Coca-Cola in the past video, that was around 300 billion when we did the analysis. So this is even bigger than that, like 20% bigger than Coca-Cola, even though you might have never heard about it or saw their products. We're gonna go through the checklist that you can see on the right, 10 item checklist, and I'm gonna explain what each of them means. We're gonna give you the score, and if possible, at the end, put a price on the stock that we think, or I think, because I'm making the assumptions here, that I think is worth, and then you can do your own. Again, more on that in the future course, so if you're interested, drop a comment, anything. We can make videos on it. It's going to be in the course. It's going to be awesome. So market cap, enterprise value is higher than market cap, which tells us there is more debt in this business, because what enterprise value does, you take the market cap, add the debt, and deduct the cash, because those things, you can get that anytime you want basically, and cash is not doing really anything, so you can just deduct that. So this is sometimes a more appropriate representation of the company value. Also, what can we see? We would like to see growing margins from first glance. So let's see, gross profit margin in the past 12 months, basically exactly the same as in the past 5 years average. So gross profit margins are not going anywhere, it looks like. But again, this is retail. Retail margins are very thin, and it's not actually that thin. It's not exactly retail. Retail would be lower, I think, but there isn't much change in the gross profit margin. However, net profit margin is where we can see a pretty big difference. So in the past 5 years, it averaged 18%. It's up to 24%. So that is massive, increasing your profits 6% within like 4 years or something. You got to look more into that. What happened there and what that is attributable to. In fact, we can go into the income statement. I don't want to shock you with numbers. You don't have to understand all of this, although if you want, I can explain it sometime. What I'm looking for is net margin. I can see there were better years, poorer years. So this is the 5 years, where we get the 5 years number. And then I was curious. Anyway, you can find this for years, and you can find it for past quarters. And if you take the last 4 quarters, that's going to give you the past 12 months, trailing 12 months. And then you can see that, oh, this is probably why in this past 3 months we had a 50% net margin. So you would go through the numbers and figure out why that might be. Because the pre-tax income is also higher. We're going backwards here, but that's not a problem. Because this is the top of the line. We basically made the same amount of money, smaller even. Gross income, smaller a little bit, but here there is some unusual expense that is not explained, but is a huge number relative to the others. So that's when you would pull out a form called a 10K that companies file every year. It's like a 150 page document that explains every single line, most likely, about all these financial statements. So even though it is not explained in this aggregated data on financial websites, in their 10K they most likely explain what this is and like why this occurred. So I would look into that to better understand that. That would be a crucial thing. If you can calculate with this profit margin going forward, or it's gonna fall back to this or somewhere in the middle, that would be nice to understand, but this is a big plus. Let's see what else we can see. Pre-E ratio looking decent from afar, but we're going to take a closer look at that going forward. Let's see, dividend amount. They do offer a dividend, and the annual dividend is $5.20, which means they are paying quarterly, and the dividend yield is 3.45%, which is respectable. In the past 5 years, it's been growing at 3%. Annually, so it is above long-term inflation, but by not a lot. So it is growing. Inflation isn't likely going to eat it away, but it's rather going to be stagnant. So no huge dividend increases, but that might be attributable to the fact that JNJ is known as a dividend aristocrats. This is a set of companies who have been increasing their dividends for at least 25 years. You can see there are 69 companies currently in here. There is JNJ somewhere in there, yeah, right here. And I think JNJ is also called not just a dividend aristocrat, but a dividend king, which is for 50 years. And as you can see, for Johnson & Johnson, years of dividend increase is currently sitting at 64 years. So in 64 years, which is what, like 1960, the 1960s, they have been increasing their dividends. This is their own website. This is the dividend history. And if we start going back on the page, as you can see that these numbers are just decreasing, meaning that it is in fact increasing. I'm looking at the amount per share, value. So this is nice to see. But what you have to note is that these dividends are paid out from the free cash flow. So you gotta understand how much they pay out in the trailing 12 months. This was $12 billion essentially, and they make about 20 billion in free cash flow. So that's about 60% that they pay out in dividends, which is okay. If you add share buybacks, we're sitting around 81%, which raises questions about whether they have enough money to reinvest in their own business, buy other companies, and pay down debt, because the other two things are included in this, which is issuing dividends and buying back shares. It's what you can do with free cash flow. So it is a high number. There is no set value, what is good and what is not. When I started looking into stocks, I read somewhere that payout ratios, which is just dividends, we talked about being at 60%, below 70 is okay and sustainable. I use the augmented payout ratio, which also includes share buybacks, because I think that is also important, but I don't know what is a good value for this. If you know, tell me. I mentioned you can use it for buying other companies, free cash flow. They are buying companies. In the past 5 years, they bought $40 billion worth of businesses, which is, I would say, a considerable part of their market cap, considering they are a very old company, talking 1887, it's like 150 years-ish, and just buying $40 billion worth of companies and having your market cap at 360 billion, although some could depreciate or go down in value that you buy, so it doesn't necessarily translate one-to-one into market cap. But you want to make sure and look into how much this growth, or the growth that we will see, is attributable to buying other companies or to Johnson & Johnson's own performance. Right? Because that is always the question, whether the growth comes from their own operations or is it just growing because it's buying more companies, and as you add more companies, your revenue and profits obviously going to grow if you're buying good companies. So just, is it still a healthcare R&D retail company that you know Johnson & Johnson for, or is it a holding company just buying other companies to boost up its own profits? That's something you have to figure out always. Anyway, let's get started with the 10 ticks, I call it. And first of all, we're gonna look at the revenue. We want revenues going up. For this, I'm using Market Watch, perfectly available public information. And columns here go from left to right. That is important for me. That's how it makes sense to me. Be careful on the sides. It might go the other way, which I see some reason in, but I don't quite like that. So we're going from left to right, and we want sales and revenues. The top line that the company brings in is up from 82.5 billion to almost 89 billion. So this is a check mark, the first, and this is up 7.5%, which is nice to see. It's not huge growth, but again, it is a huge company, and it is a defensive sort of approach in terms of products. So people, although people are not that let's see if you would, as Johnson & Johnson start to increase your prices, you could get this growth higher as you will bring in more revenue. The question is how sensitive people are to buying your products, the price of these products, because 1, they can stop buying it, 2, they can buy less of it, or 3, they can swap and switch to a competitor. So this is called price elasticity. You might also look into this and how loyal people are to your brand. These are very interesting things that you would take into consideration when doing like a full analysis. that it would also be cool to do on this channel sometime. All right, so it's up. It's a huge company. It's harder to grow large numbers, and because it is such a conservative and staple kind of business, it's not going to grow a whole lot all of a sudden. Next up, as you work down your way in the costs section, you arrive to net income, which is what you sort of bring home on paper. And this is actually down from 14.7 billion to 14 billion. We had some ups and downs along the way. So this is an X. It's down 4%. It's not the end of the world, but we have seen better years. So you would go and see where the difference arose from and what makes you earn 21 billion in 1 year and then go back to 14. So that's something you would want to take a look at. And if you take these, I average these out, so I get more smoothened out. As you can see on this right hand little graph that I have here, it's sort of almost a perfect wave of how net income has been. If you take 5-year average of these numbers, it just sort of smoothens out this curve and gives you one value, which is 15.87 billion, as you can see on the right hand side. And now that you know that, you can go back, take the market cap, which is in profile, and you're just gonna divide, not in profile, in overview, sorry. So you're gonna go to overview, take the market cap and divide it by the 5-year average net income, which is gonna give you the price to earnings, because the price is the price for the company, earnings is how much they earn in a year. This is gonna give you a number, which is understood in years, and it's gonna tell you how many years the company needs at the current price to make your money back, sort of. So that's your like return period at current dates. If you do that, that is 22.85, which is an X, because we would want this to be under 20 to be considered not expensive, overpriced. There is sort of some room. Companies around 12, 15 considered undervalued, around 12 and below 12 they are undervalued, around 15 to 18 they are fairly valued, and above 20 is when it gets more expensive. As I explained, this is years, so taking more years to make your money back makes it a worse and worse investment, so that's what you want to look out for. But if a company has growth potential, people are willing to pay a higher PE, because if the earnings start growing in the future years, this number is going to get closer, it's going to get smaller and smaller as more net income makes up for the higher price that you're paying now. I hope that's clear. It's not easy to wrap your head around, but we can do an example on this if you want. All right, and then another thing that I don't see a lot of other people do, and what I love to do, is also take a look at the industry median PE. Just broaden your horizons and look at other companies and see how they are doing. Because what I told about PE ratios and the ranges, what is considered undervalued, good value, okay, and expensive, it is not true for every industry. So I put this in to make you think about what the industry characteristics are like. There is this trading view that I absolutely love for charts. I'm just seeing price actions, but I also discovered they have this very fantastic profile pages for companies. So if you go JNJ, Johnson & Johnson, you have these breadcrumbs on the top, and if you go to the last and most exact category, pharmaceuticals major, you go in here, you have tons, in this case, tons of competing companies, and you also have a PE column. So you can take that, average that out. I put them in a line in increasing order. I take the middle one and I say that is what the industry median is, and that comes to 18.97. Johnson & Johnson's PE value is higher than that, so that's an X. What this means is that Johnson & Johnson is more expensive than what you would expect from this industry, so you get a better understanding of the price in play. Now next up, I want to take a look at how well they are able to generate money. This is called return on invested capital. So the money that they put into this business, either through debt or equity, for every dollar that gets put into this, how much they are going to earn. We're looking for above 10%. 9 to 10% is the market average. 10 is just a round number, and it's more strict. So I like it because it makes you more conservative. And so less deals would appear good for you, which means that you are only going for the best ones. But this is not a sort of generally agreed on metric. So on different websites, you're going to see different numbers. I have my own, and that comes to 9.15. So it's an X because we're looking for over 10%, but it is reasonable market average. It's around the market average, and on different websites I have seen higher numbers, but again, different websites use different formulas, so it can be anything. I've seen like 12% and then 14%, but let's just say it's around market average. So it's not terrible, it's not amazing. All right, 1 tick out of 5 and currently 4 X's. It's not looking good, but let's see if we can improve on that a little bit. Next up is my favorite topic, shares of outstanding. Basically, we want this to be going down, because what that means is that the company is buying back their own shares, making owners bigger owners of the business. Because if they are reducing the total number of shares, each share is going to be worth more, and that's absolutely fantastic to see. I use diluted shares for this, and it is down from 2.67 billion to 2.43 billion. I hope I said that right. It is a 9% decrease, which is a check mark. We'll love to see that. It's a nice and steady decrease, about 9% over 5 years. We can live with that. What's important is that it's a clear tendency of going down. I would want to look into whether they have more share buyback plans, because if they do, that could mean that they think the company is at a good valuation and it is worth buying back the shares, because they also want to make a good business buying their own shares. So it's not only you. That is usually, not usually, I wouldn't say usually, but that could be an indication of whether it's good or not to buy a stock. Something definitely to consider. Okay, so this is good. We'll love to see that. Next up, I want to take a look at the rate at which their long-term liabilities, so basically debt, has been growing, and their revenue, the rate at which that has been growing. And we're going to compare the two, which is going to tell us whether they manage, or like, it's going to tell you based on the amount of debt that you gained or lose. No, that's not based on the amount, like based on the change in your debt level and your revenue level. Were you able to make revenue using the debt only, or you could have, or you have like other sources to grow your business from? We know the revenue growth, you can see it here, we already calculated in the first. Long-term liabilities is going to be in the balance sheet, which is like a snapshot of your company assets, sort of, and liabilities, like what you have and how you finance that. Now, there is a section called liabilities, and you have total current liabilities and total liabilities. Now, current liabilities are within 1 year, and long-term liabilities are beyond 1 year. So what you would do is, because you don't have total long-term liabilities, you take total liabilities and deduct total current liabilities. And that will give you total long-term liabilities. So you take this number, 111 billion, deduct 42.49 billion, do this for all rows, get that, average it out, and then you will get that that number has been going down 15.68% compared to the revenue going up 7.57%, which is very nice to see. So that is a check mark, because you managed to decrease your debt by 15% essentially, and still manage to grow your revenue by 7.5%. So that puts you in a better position. You're making more money and doing it with less debt. That is very nice to see. Now, next up, we're going to take a look at the free cash flow, which we talked about a little bit here, paying dividends and buying back shares from, and also reinvesting in the business, buying other businesses, and paying down debt. Now, if you have less debt, you're also more likely and you're more free to pay dividends and buy back shares because you don't have to pay down as much debt. Now, the way you get free cash flow is you go into the cash flow, which is the third financial statement. If it allows us, now it registered the click. Brilliant. And the formula is really simple. You're going to take net operating cash flow and you're going to add the negative capital expenditure. So plus minus is a minus. So this is going to come out to around 20 billion. You do this for all the 5 rows and you average it out to get obviously the average, but we're going to want to take a look at the 5-year growth pattern. And Market Watch, if you scroll down, actually gives this to you. So we are actually down from 20 billion to 19.84 billion, which is an X. It's down 1.7%. Let's see, it's sort of is stable. We had a little dip here. I think this was 2022. You could figure out why that is, although it's a bit harder to understand. This is a lesser analyzed financial statement, but it is relatively stable, and the average is 19 billion. And you can do the same with this number as you did with net income, because this is harder to manipulate than net income. So that we're also going to compare the two numbers to see how close or off they are from each other. Now you take this $19 billion average and you divide it by the 362 billion market cap. I'm actually rushing forward, but no problem. You divide that and you would get 19.04, which means that in 19 years of you buying this business, considering it keeps the same average free cash flow, it's gonna make your money back within the company in 19 years. So that is a sort of okay number. It's sort of an okay number. It's not terrible. It's not amazing either, but it is a check mark. And the item that I missed, what we can also do with the free cash flow is pay down debt, as we discussed. And now that we know we make 19 billion every year, and we also have a long-term liabilities number that we just calculated when comparing the ratio, the growth or the rate of change of that to the revenue, you can take that and divide that by your free cash flow number. So it would give to you how many years you would need to pay down your debt. Now we want this to be under 5, so to give it a comfortable position. And if you do that, you get that it actually takes only 3 years to pay down the debt, considering you use all the free cash flow to pay down the debt, so you're not reinvesting in the business, issuing dividends, which they do, and they take great pride in, not to lower it, not buying back shares and not buying other companies. So in reality, this is gonna take a lot longer, and there is certain ways how companies finance these things and how they pay down debt. But below 5 would give us sort of a reassurance that it is a situation that can be handled very easily, probably. All right, that gives Johnson & Johnson a 5 out of 10, which is nice. Let's go and see if we can put a price on this company. Right, so this is my discounted cash flow analysis model. What it does is that we have the free cash flow from the 5 previous years. If you want to analyze more, or if you have sort of a more wobbly line, you can go back and look at other websites so you can fill out previous years. But for this purpose, I think this is a very stable company, and we can just simply consider all the years, use the average that would be here. Unfortunately, that is lower than the starting year, which means like the ending year is lower than the starting year, which would mean that we have a negative growth here. And so for negative ratios, my assumption here that would play out interestingly, but we're going to see how it works. Basically what this does is that it takes the average, or I can change it, we're going to see different versions, and then I project it into the future with a growth rate and then bring it back to today's value. It is my assumption that in the first 5 years it's going to grow with the currently negative average growth rate, and then in the following 5 years it's going to be half of that. Now let's see what it brings us to. Now if you do all that, you sum those up, you're going to get an intrinsic value of 381 billion. You do add the cash and deduct the debt, 368 billion. You're going to divide that by the number of shares, which is going to give you the price. So it is saying that the intrinsic value is $151.60. It's currently 150.73. So there is, it looks like there is about 0.58% upside based on these assumptions, which might or might not be true. There's a lot of assumptions going on here, but let's see how this changes things. We could, let's just say, I'm just going to give you an example, but it's not really, I don't really want to derail you, but let's say we don't ignore 2020 because we're gonna do like, I don't know, 2021. Interesting that these were pandemic years and it wasn't really that high, or this might be like falling back to like a more standard level. You would have to look at the previous years, because if those years are around this number, maybe we can justify taking a look at going from 2022 to 2024, in which case it is a 7% growth year over year, and that would really boost up the value here. But I do not think this company is going to grow 7% and half of that in the next year. So this is just, you know, for fun to show you. I think this is more realistic, and we can see it is about fairly valued. I would say there is a little bit of upside, not a whole lot. But if you think there is future in this company and you think the price is justifiable, this might be a safe pick to add to your portfolio. Let me know what you think. Don't forget to subscribe to the channel, like this video, and more importantly, leave a comment and tell me what you would like to see next, because I'm happy to help you out. And don't forget to visit my website, sign up at the bottom of the page, so that when the course launches, we can get you into that and you can get a firmer grasp on this topic. And I hope to be of help there as well. Thank you very much for your time. I hope you enjoyed this and found this valuable. I hope to see you in another video. Let me know which one. And thank you again. Bye.